Good morning, everyone. Thank you for joining us on Morning Markets from the team at True Potential. Today we'll be looking at how asset markets performed yesterday and also look at some of the economic data that we've seen this morning. Firstly, looking at asset market performance from yesterday, turning to equity markets, relatively subdued performance really from equity markets yesterday. Not surprising given the positive backdrop that we've been discussing over the past number of days. So we did see most equity markets marginally lower on the day. Within that, however, it's just worth noting that we saw all three indices in the US, that's the S&P 500, NASDAQ and the Dow Jones, all hit new record high levels, but they did trade off a little bit from those highs into the close. I think really yesterday a lot of the attention and focus has to be given to what we saw in sovereign bond markets, and we've been discussing over the past number of weeks how we've seen sovereign yields gradually and incrementally move up over the course of the past number of days. Thinking about that yesterday, we saw more of a pronounced move in the sovereign bond markets, particularly if we look at the US, where we saw the US 10-year yield move out about 11 basis points over the day, closing above 130, ending the day at a 131 yield there. For a bit of context to this, just take us back to the beginning of the year. We started the year with the US 10-year yielding 0.91%. So there you can see quite a significant and material move in yields over that period. And really, what is it that's influencing sovereign bond yields at this point in time? And indeed, that number that I touched on in the US, very similar to movements that we saw in other sovereign bond markets across the globe. The driver behind this and the change in sentiment and view from some market participants is around really the outlook for inflation and inflation expectations. We've discussed over the past number of weeks indeed how break-even inflation rates got down to exceptionally low levels in the midst of the COVID-19 issues that we were experiencing in the first and second quarter of last year. Over the course of 2020, we've seen inflation expectations increase. And where we're sitting at today, we've inflation expectations around 2.1% if we look at break-even implied inflation rates. So that has been a step change in inflation. And what is our inflation expectations, I should say. What's driving that and what's brought that more to the focus at this point in time is that ongoing debate in the US and other countries as well about the need for further fiscal support. If we think about the US, we've discussed it, 1.9 trillion. It's the scale of that relative to the GDP that is concerning some individuals or bringing more focus to it. So if we think about it, it's about a 9 or 10% fiscal impulse. That's a lot of additional money and impulse to come into the system, it raising concern that it will bring inflation with it. The other side of that, there's the debate that suggests it's required, it is needed for the economy, and it won't have that same impact on inflation given some of the more structural factors in the backdrop, be that demographic, deunionisation, etc. So it's a really interesting debate in the market, but it does throw up a number of challenges for the market, and in particularly the central bank, particularly in the US, to think about how they're going to communicate around the movement that we've seen in yields. What is their comfort level about the 10-year? We've got some commentary from, I think, Jerome Powell next week, and it'd be interesting to see if he does sort of push back on some of this movement that we've seen in yields, but certainly something really worth watching and does speak to a bit of a change in sentiment and how inflation is being viewed. And the other thing just to look at from yesterday, we touched on energy markets. Really that support for the oil market has continued to be there given that backdrop of challenging supply production issues in the US given the cold weather snap that we're seeing there. Just on the economic front then yesterday, looking at Eurozone, the GDP for the fourth quarter came in falling 0.6% year on year. For the full year, what did we see for the Eurozone? We saw GDP contracting 5%. So again, it gives you some context of this relative difference between different countries and their responses to COVID-19 and the impact that that's had on GDP growth, or lack of growth, I should say, last year. Just also then looking at the German market yesterday, economic sentiment index came out, and that improved to 71.2 from 61.8 last month. And again, that just speaks to the slightly different makeup of the German economy, particularly as it relates to manufacturing and industrial activity, which we know has remained positive and continues to see positive traction at this point in time. Just looking to the day ahead then, what can we expect? We've seen equity markets in Asia marginally lower, so that's indicating that futures in Europe, UK, US at this point in time are looking to be slightly lower when they open as the day progresses. We've had some interesting, I think, and in a good way, economic data out of Japan, which continues to build a little bit on this story we've been discussing over the past number of weeks, where we saw continued economic growth. So we saw exports coming through, increasing 6.4% for January, again speaking into the role that Japan has in global trade. We saw that also coming through in machine tool orders for December, which were positive. And then just finally looking a little bit at inflation data from the UK this morning. CPI, core level, increased 1.4% year on year. That's unchanged from what we had last month. One of the more focused factors within that is what's happening within producer prices. So we saw producer prices increasing 1.3% year on year and also increasing 0.7% quarter on quarter. That has yet to feed into output prices, where they continue to show that deflationary trend where they fell 0.2%. But it's certainly a trend that merits monitoring going forward to see how increasing producer prices feeds into output prices and then into consumer CPI. I'll leave it there for today. Please do subscribe on our YouTube channel, and we look forward to speaking with you again tomorrow. Many thanks.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.